Hi, this is John Prasinos, Editorial Director of Investing Daily, with a video update for Tuesday, June 23. While the rest of 2020 promises to be uncertain with choppy trading and sell-offs ahead, the market has rallied from its March 23 low, but don't get complacent. We're in the midst of a wild presidential race, to say the least. The economic fundamentals they're appalling. And coronavirus cases are rising. They're rising, not falling. In fact, last Friday, the World Health Organization said that the world had entered a new and dangerous phase of the coronavirus pandemic. When the proverbial stuff hits the fan and stocks crash again, will you be ready? In this video, I will outline 8 steps that proactive investors should take now to build wealth and also preserve capital. Number 1, rotate into defensive stocks. Sector rotation can beat the market. Take a look at the following chart. As we face economic contraction, increase your exposure to defensive sectors such as healthcare, utilities, and consumer staples. I'm particularly keen on utility stocks. Utilities tend to perform well during economic downturns, in large part because they provide essential services that people just can't live without. Utilities are dividend payers with solid balance sheets, and as such, they tend to be recession resistant. Healthcare and consumer staples also constitute essential services. Number 2, go to bonds for ballast. In turbulent waters, bonds can help steady the ship. You may be a growth investor and still several years from retirement, but in a recession, such as this one, don't give short shrift to fixed income. You should be rotating towards safe havens. I recommend bond funds for greater diversification. Notably, short-term bonds are less vulnerable to interest rates than long-term ones. Number 3, decrease your portfolio's weighting in cyclicals. This is no time to be heavily weighted in cyclical sectors, such as consumer discretionary goods. During this economic contraction, and make no mistake, we're in a severe recession, rotate into non-cyclical, more stable companies that provide services that are consistently used regardless of economic or market conditions. Number 4, diversify among asset categories. Spread your portfolio among value, large cap, mid cap, small cap, growth, and income stocks. Number 5, seek global diversification. Don't withdraw from the world stage and become a parochial investor. To be sure, emerging markets are grappling with multiple crises, but the global diversification imperative applies to all geographical regions and countries. Number 6, add quality dividend stocks to your portfolio. Dividend-paying stocks are proven tools for long-term wealth building, but they're also safe harbors because companies with robust and rising dividends, by definition, sport the strongest fundamentals. Number 7, make sure your portfolio contains gold. Geopolitical turmoil and trade war uncertainties have propelled the price of yellow metal in recent months. Gold probably has further to run. The rule of thumb is for an allocation of between 5 and 10% in either gold mining stocks, exchange-traded funds, or the physical bullion itself. And finally, number 8, use stop losses when buying stocks. Using this order, the trader will preset the value based on the maximum loss the investor is willing to tolerate. If the last price drops below this fixed value, the stop loss automatically becomes a market order and gets triggered. As soon as the price falls below the stop level, the position is closed at the current market price, which prevents any additional losses. And there you have it. It's not too late to follow these defensive measures. If you have any questions or comments about portfolio protection, you can reach me at mailbag@investingdaily.com. In the meantime, stay invested and stay safe.